Hi, I'm Mark. I'm a former investment banker and I've been managing my own money for about the last 20 years. I run a financial training business and work with some of the biggest commercial and investment banks. My aim here is to help you broaden your investment horizons, or maybe just understand a bit more about what's happening in markets. So each month we build a momentum portfolio. We take funds which are readily available, we follow the portfolio for 6 months and we benchmark it against the MSCI All World Index. So, $64,000 question, can we beat a major index by using market momentum data? Well, over the last 6 months, we've beaten the index 4 out of 6 times. Here are our portfolio picks. Now you'll see I've selected 2 portfolios this month, a regular momentum portfolio and my zero knowledge portfolio. So let's dig into what's going on and I'll explain. Now the impact of the war has been dramatic. Some markets are in correction territory, down over 10%. With the exception of oil and gas stocks, no sector's been spared. Bearish sentiment about the impact of the oil shock has been exacerbated by the leverage in the system. Investors have unwound positions, selling off liquid assets, bonds, gold. Selling has been substantial. It's interesting to see how the impact of the war closely mirrors previous conflicts. So I guess if you'd done your homework before, you would have been ready and you would have sold. Now it's unfortunate, but this doesn't give us much of an indicator about what will happen next. And if we think about kind of 2 extremes, there are 2 sort of scenarios with a range in between. I guess at the happy ending end, peace breaks out and traffic resumes in the Straits of Hormuz. Everything slowly goes back to normal. But with inflation higher for a period as oil production normalizes. Now that sounds great, but it's going to take a long time to come about as there's been a lot of damage done to capacity in Russia and in places like Qatar as well. Now at the other end of the spectrum, war continues, we get more damage to infrastructure and production capacity, and there's a long-term disruption in the Gulf of Hormuz. A global recession follows as oil prices stay high and shortages occur globally. Now that's more realistic than you might think because Europe's soon going to start running low on jet fuel. Asian countries are already rationing. Now I'm recording this the day after the ceasefire. It looked like peace broke out. Markets bounced hard. Today, not so much. Now, of course, there are many possibilities between these 2 extremes, but it just kind of shows the range of uncertainty. Now, performance over the last 4 weeks has been dramatic, not surprising. Only oil and energy-related funds are in positive territory, really. However, as we've seen talks of peace and then the ceasefire, the strongest bounce back has been in those funds which went into the war with the strongest momentum. So, for example, a week ago, Barings Korea was down nearly 17% since our last blog. A week later, it's now only down 1.2%. Royal London, Asia Pacific ex-Japan, it's a similar story. So, there we go. Now, the performance of last month's portfolio has also a different sort of message in it, which is about human interference in these algorithms. When we started, I said, and that was 20 months ago, pick 4 funds with strong momentum, but aiming to diversify. Now, unconsciously, when I picked the portfolio last month, I discounted the possibility of an actual war. I didn't select February's big winner, which was oil and gas. Oh dear. And I did so thinking that longer term, this would just be it would be over. Trump would chicken out. There we go. So that's the fault of the manager. Maybe fire me as the message and stick to the algorithm. Anyway, the implication of all of this is that if war stops, the momentum we were following is going to reassert itself. If the war stops, yeah. So have a look at my Substack to see the individual portfolios. I don't think it's very interesting. It's a similar picture across the assets. The bigger question today is whether now is the time to be starting a momentum portfolio. Does it make sense to take the risk of taking on an equity position when we can earn 4.5% in government bonds or higher if we take risk in areas like floating rate mortgage-backed securities? I guess another way to ask this question is, if we're completely ignorant about the outcome of the war, what mix of assets will do us the least harm? What zero knowledge portfolio makes sense? With that zero knowledge portfolio in mind, there are some obvious asset classes to choose. Firstly, oil and gas. For obvious reasons, prices are going to stay elevated. Inflation, so broad commodities. One thing we do know is inflation is going to stay higher. And the impact of oil and gas prices hasn't finished feeding through. Mortgage-backed securities. Now, particularly if we buy subordinated pieces, we're going to get very, very high returns. And we may see some poor price performance in the short run, but we can earn very, very high yields. And I guess the fourth obvious area is insurance. Returns are not correlated with the broader market, and they're not cyclical in the classical sense either. So with that in mind, and doing a conventional momentum analysis, this month I'm offering two portfolios, a zero knowledge and a straightforward momentum pick. There we go. So you've made it to the end of my little video. Thanks again for watching. If you're interested in more detail about the portfolio and the process, visit my blog. It's on my website, capitalcitytraining.com, or search for Mark Woolhouse on Substack. Both give you a full list of the funds. I'd also like to mention that the data comes from Salty Dog Investor, a UK-based investment data platform. We're partners with the show. They're currently offering you a 2-month free trial. See you next month.